Welcome to Fibonacci Retracement and Extensions 104. I'm Darren Maddox, and today we will learn the psychological behaviour of Fibonacci values in financial markets. This is my PhD specialty subject, so I do look forward to rambling on. There'll be no charting today, as we've covered all of the beginner stuff for that, and I hope you all take something away from this that'll stick with you. So, much like supermarket shopping behaviour, Fibonacci retracement levels influence market decisions through subjective perceptions of deals, creating zones where traders perceive value and decide to buy or take profits. They are also objective levels set by investors, traders, and algorithms alike. So I'm going to continue with the shopping metaphor today. Imagine you're eyeing up a high demand item like a video game console, stay priced at $500, or a premium cut steak at $100. You don't want to pay full price, so you wait for a discount. Suddenly, 38.2% off sale drops. The price of the console is now about $309 and the steak $62. Now, for many shoppers, this feels like a great deal. Not too shallow to seem insignificant, but enough to trigger a sense of value. More so if the item is in high demand, flying off the shelves recently. This mirrors why things like wave 4 and Elliott wave often retrace to the 38.2% Fibonacci level after a strong bullish wave 3. The recent upward momentum creates hype, and investors see the minor pullback as a bargain entry point rather than a reversal. So prices can often bottom here. In stronger trends where FOMO is rampant and the asset's popularity is even higher, buyers jump in even quicker, unwilling to risk waiting for deeper discounts. This is the same as the 23.6 Fibonacci retracement in financial markets. People just can't wait to buy the dip. Conversely, in weaker trends, more hesitation leads to deeper retracements as uncertain market participants demand bigger risk-reward ratios. Another key psychological area is 50% off, and you see this all the time. That drops our console from 500 to 250 and our steak from 100 to 50. People love a 50% off sale. What a bargain. This midpoint feels intuitively fair, like splitting the difference, and further acts as a psychological equilibrium where buyers step in. Now, human psychology truly amplifies discounts exceeding 50%, particularly the golden pocket, 61.8 to 65% off. At this value, the $500 console hits $191 and the $100 steak is only $38. Suddenly, it's a steal. Everyone wants to take advantage of this opportunity before it's too late. In financial markets, this golden ratio becomes a self-fulfilling prophecy in the sense that we have unconscious market participants bidding the special offer on price, as discussed above, and also conscious market participants buying. Traders often describe the golden pocket as where the perceived value outweighs the subjective fear, drawing in buyers once more. For more volatile assets like altcoins and low market cap stocks, the psychology shifts even further. These require even steeper discounts to balance the heightened risk. Here, the FOMO is tempered by caution. Small caps or speculative assets like altcoins experience wild swings, so investors demand deeper retracements to feel the reward that justifies the volatility. This is why altcoins have their own golden ratio at 78.6 during corrections, as the mass of participants wait for the extreme value perception before piling in, reinforcing the level through subjective and collective behaviour. These retracement levels blend subjective buying, that is driven by personal emotions like greed, fear and optimism, with objective factors such as historical price data and trend strength. Subjectively, a trader might buy a 61.8% because it feels like a great deal based on a past experience or market hype. Objectively, they might confirm it with volume spikes or confluences like moving averages aligning at this level, providing data-backed rationale. Conversely, levels less than 50% create panic for those who bought at the top, as they have now lost over half of their money. Large capitulation volume takes place straight into the hands of the big players. This is why price often turns around when you sell and goes without you. We've all been there when we first start out. In highly liquid markets like Forex, where trillions trade daily, these levels, the Fibonacci levels, are extremely accurate and self-fulfilling. Pairs like Euro-US dollars or GBP, JPY conform remarkably well to Fibonacci because countless traders, institutions and algorithms watch them simultaneously. If enough participants place orders at the 61.8, the sheer volume creates that support and resistance, turning predictions into reality. Much like Black Friday behaviour, where everyone rushes to the discount aisle, driving the frenzy even further. Fibonacci extension tools are calculated directly on the Fibonacci retracement depth, projecting potential targets for the impulsive move. These levels, such as the 1618, 2618 and 4236, serve as subjective profit-taking zones, where traders feel psychologically satisfied to exit, often influenced by round numbers or significant multipliers. Traders often set subjective take profits here because it feels rewarding without greed overriding caution. Objectively, historical data supports this. In trending markets, extensions like the 1618 frequently mark exhaustion points where momentum fades, backed by confluences like overbought RSI, high volume nodes, and EMAs. As part of their strategies, most traders make most of their money on only a few trades a year that win big, while the small wins keep them in the game. You don't always want to exit every position at 1.618 in case you miss a huge move, and that's why it only forms part of a larger trading plan. Finally, different asset classes exhibit distinct Fibonacci retracement probabilities, influenced by their liquidity, volatility, and participant psychology. Indices like the S&P 500, representing broad market stability, rarely retrace deeply, because institutional buyers view minor dips as buying opportunities in a resilient economy. Commodities, conversely, swing more aggressively due to supply-demand shocks, leading to deeper retracements like the 61.8 or 78.6. To optimize for your favorite asset, test historical fibs. This blends subjective pattern recognition with objective backtesting, enhancing your edge in diverse markets. In summary, Fibonacci power lies in psychological resonance, amplified by mass participation, where levels self-fulfill through collective action. Balancing subjective impulses with objective data ensures these tools remain effective for buying and profit-taking. I hope you enjoyed this beginner series on Fibonacci retracement and extensions. Don't forget to subscribe to get notified of my upcoming beginner series and trading strategy walkthroughs. Please leave a comment below or any questions, and safe trading.